Hello, everybody. Welcome back, entrepreneurs. In today's session, we're going to be talking about maximizing deductions, last minute tax tips for you entrepreneurs. So, we're going to be focusing on how you can reduce your tax bill even as the tax season is starting to wrap up. It is never too late to take strategic action. So, before I get into this topic, I'm going to introduce myself. So, my name is Shane Harris, and around here on these social media streets, I'm also referred to as Shane the Negotiator, and I help coaches, consultants, and service providers, entrepreneurs in general, who are overwhelmed and lack guidance to achieve true financial freedom. And I do that by providing expert tax and coaching services. That is what I do. That is who I help. So let's get on back into today's topic of maximizing deductions. We're going to be talking about last minute tax tips for you guys. So let's get into understanding deductions. So deductions, of course, it lowers your taxable income. So remember, I stated before in the previous um, playlist, YouTube playlist, Pathway to Financial Mastery, I gave you the difference between deductions and credits. And deductions lower your taxable income, and credits reduces the taxes that you owe. So deductions is going to decrease your income and therefore giving you less money to pay taxes on. And the credits is going to be whatever taxes that you owe for that particular year. The credit is going to decrease some of those taxes owed by receiving a credit. Okay, so that's the difference between the two. So again, deductions lower your taxable income, meaning you are going to pay taxes on significantly less money. So for business owners, this can include a wide range of expenses from the year before. So let's get into how you can identify and maximize these opportunities, even for last minute filers. So, for one, you're going to start by reviewing your expenses. You want to start by reviewing all the expenses that you had the previous year. This include office supplies, business travel, and equipment purchases. So these three are usually the ones that is generally missed because many times you may not know about these things or you just may overlook it. So again, go back and watch the playlist for this year and also for last year's playlist where I'm talking about the pathway to financial mastery, and the 2024 playlist for this year where I have a lot of topics on home office expenses and things like that. So those office supplies, a lot of it is generally missed. Some of it is home office related and some of it is related to your actual business, the supplies for your business. Of course, those business travel. So oftentimes you are taking business travel trips for your business, obviously, and you may have paid for it with your through your personal funds. And it doesn't mean that you can't deduct it because you paid for it out of pocket. You can actually reimburse yourself through the business. Okay. So don't forget those business travel expenses that you may have had. You might have went down, like I'm here in Georgia, you might have gone on over to Florida and you had some business travel there, or you might have went overseas to Costa Rica or something and you had a conference, you had a speaking engagement, whatever the situation might have been. It has to be business related. It can't be personal. You can't take the family to Disney in California or in Florida, Disney World or Disneyland, and then say, hey, that was business travel. Nope, it's not business travel. Now, unless the entire family is on payroll and you took a trip down to Disney to talk about business, then maybe that's a little bit different. But don't just go and do that because you heard me say that and you're like, oh, that's a great idea. You have to put some things in place to actually do that. It's plausible, but you have to put some things in place before you can do that. And I'm going to say it, and I said that again. So equipment and purchases. So you might have purchased new equipment for your business, and equipment does not have to mean heavy, big, heavy machinery. Okay. Equipment can be you purchase a brand new cell phone. That's a part of equipment. And there's ways that you don't necessarily take the full deduction, especially these cell phones are not like $50 or $100 like it probably used to be 20 years ago. These cell phones are like $1,000, $1,500, $2,000 even. So that's a business expense that has to be amortized over the next, depreciated over the next couple of years, meaning you take a little bit at a time as a deduction until the entire amount is recouped. Okay. So if you spend $2,500 on a cell phone, you're generally not going to write off the entire 2,500. Similarly, if you bought a brand new laptop or you bought a computer, these things need to be depreciated over the life expectancy of what it would generally cost. So generally it's going to be not generally cost, over the life expectancy of the wear and tear of the equipment. So for computers, for cell phones, that's generally going to be like a 5-year period. If you purchase something like a car, then of course that expectancy may be a little bit longer, 7 years, 10 years, or something of the sort. So don't forget those equipment purchases. And I know you guys are confusing the difference between purchasing equipment for, and you can write that off, the entire expense off in the year that it was purchased for, versus depreciation over a period of time. And that's why I keep saying that you need to consult with a professional, because this is getting into advanced taxes and advanced tax planning. And you want to make sure that you maximize your deductions by doing the right things. Okay. Have you accounted for everything? So you want to make sure that you comb through your books, you comb through your bank statements, you comb through whatever records that you have, so that you make sure that everything is accounted for, because you don't want to have to spend more in taxes than necessary, and you don't want to have to spend too little in taxes, because then you'll have to pay that at some point in time, and those fees and penalties is likely going to be attached to it, and also opening yourselves up to potential audits, and also, even worst case, opening yourself for your business deductions and credits to be disallowed, and also for your business to be reclassified as a hobby instead of a business. And you definitely don't want those things to happen. So sometimes significant deductions are overlooked. So ensuring that you're keeping comprehensive records to back up these claims is going to be a lifesaver for you and your business. Is going to alleviate a whole lot of headaches. Like, you're not going to have as many migraines when it comes to your business if you have the appropriate records. So home office deductions, as I mentioned briefly, for those working from home, you don't want to forget the home office deductions. See, if you use part of your home exclusively for business, calculating the percentage of your home's expenses that goes towards that space is going to be what you're going to be able to deduct from the home office expense. And go back and watch the previous playlist where I did speak about home office expense, okay? There's, of course, the simplified options that's going to be available, but choosing the method that offers the larger deduction can make a big difference. So you can use the simplified method where you might be able to get a maximum of like $1,000, versus if you use the larger deduction where you're accounting for every expense that you had for your home office, then you can be able to write off significantly more. Okay. Retirement contributions. So contributing to a retirement plan like the SEP IRA or the solo 401k. Again, in the previous playlist, I did speak about retirement plans. So go on back over there and catch that. Not only does it prepare you for the future, but it also decrease your current taxable income. Okay. So you often have until the filing deadline to make contributions for the previous year. So we are in April now, are coming up on April. Well, the tax filing season for individual ends April 15th. After April 15th, that's it, done, over with, dead. Now, the season for business, like those S corporations and partnership, that was March 15th was that deadline. So you're already past that time. If you did not do a catch-up contribution from your business, it's too late to do that unless you go back and do an amendment, okay? But however, for your individual filing or the C corporations, you can still do those catch-up contributions, and you have until April 15th to do so. So we're March 29th now. So we're pretty much in April at this point, as I said. So you still have about 3 more days left in this month. Then you have April 15. So you have 18 more days to do the catch-up contributions from last year. So what I mean by catch-up contributions is if you let's say your taxable income is coming up at 100,000 right about now, and you're like, yikes, I didn't pay any estimated taxes. That's a lot of money to pay taxes on. So first is having that money sitting in your bank account, and you're going to get taxed on it at 15.3%, which is going to be high tax. So let's do 15.3% of 100K. Put my calculator times 0.153. That is 15,300 is your tax for 100,000. So if you decided to say, well, you know what? The maximum contribution for 2023, let me look that up real quick because I forget these numbers sometimes. So let's do a SEP IRA maximum contribution for 2023. It's like 60 something thousand. Up here it is 66,000. For 2024 is 69,000. So let's just say you like, you know what? I'm not trying to pay $100,000. I'm not trying to pay taxes on $100,000. So let's take that $100,000 and put the 66,000 into a SEP or a 401k IRA. So minus 66,000. That is 34,000 is what you're going to now pay taxes on. So we're going to multiply that by 0.153, and then we get 5202. So it's a big difference between paying 15,300 in taxes versus paying 5202, $5,202. That's a significant difference. And of course, if you have the means in your business to contribute 66,000 into your business, why not take advantage of that? At some point in time, you're going to retire from running your business, and this is money that's saved for retirement that you can live off of once you retire at the later time in life. Okay. So enough about that. Let's get into deferred income. So if possible, deferring some income to the next year. So this might mean delaying invoices for late year projects or sales, lowering your income. This year can reduce your tax liability, especially if you expect to be in the same or lower tax bracket next year. Now, it's kind of too late, at this point in time, to talk about income from last year. Last year ended December 31st, that was the end of the year. It's actually not too late to defer some of the income that you made last year for the following year. Because as I said, we're talking about late filer tips for late filing, some, deductions and things that you can get, last minute tax tips. You can actually defer some of the income. So let's say you had income of 50,000 that you defer for the following year because you had those invoices that came in December, but you didn't actually receive the money as yet. You can actually refer that to next year, so not have to worry about 50,000. So let's just subtract that 50,000 from what's remaining of the income that we had. So when we had 100,000 was our income that we did the example before, minus the 66,000 for the SEP contribution, we have 34,000 remaining. So let's say you had that 50,000, but you don't want to defer the entire 50,000 because it's going to bring your taxable income down into it's going to bring your income down into the negative. So you want to, instead of deferring the 50,000, you may want to defer that 34,000 instead. So it brings your income down to zero, zilch, meaning no taxes paid for this year. So that's just an example. Please don't use what I just said and be like, "Ooh, that's a great idea. Shane said this, I'm going to do that." You can potentially do it, but it's based on individual situations. You may not have the business type to be able to do that. You may not know how to necessarily do that. It's strategic planning. It's a part of tax planning. It may or may not work for your business. It may or may not be beneficial for your business. So get with a professional, as I always say, to determine if this is something that is going to work for you and your business. Okay. We talk about charitable contributions. Again, making those charitable donations is another way to reduce your taxable income for businesses. This needs to be done with careful consideration of the benefits and the impact on your financial statements. So if you're going to be putting money into these charitable contributions, for you're going to have the funds to be able to do so. You will either be doing that through your business or you're doing that through yourself personally. So there is a difference. You can donate to charitable contributions through your S corporation, through your C corporation, your partnership. Your LLC could have contributed to these. However, you, the individual, if you are donating to charitable contributions, meaning you use your own personal funds that had nothing to do with your business, that's a little bit different. It goes on different forms. Okay. So let's do a quick case study. I like to use Alex, the consulting firm, because they had a lot of issues going on. And a lot of times, a lot of my scenarios and of course of the case studies that I'm doing comes from this company because they were a hot mess when they got with me. And I'm pretty sure they're not going to be upset by me saying this. I'm not saying the name of the company. And, Alex is pretty cool. So he's okay with me talking about his company. So when Alex runs a consulting company, he realized in December that he had overlooked some equipment purchases, some home office setup, and of course, some of those deductions. So after we did a quick review of his expenses, he was able to make last minute SEP IRA contributions into his retirement account before their business taxes was filed by March 15th, which has significantly reduced the taxable income. So it's just a similar example to that I just gave when I did the $66,000 for the SEP. They were able to do something similar to put money into that retirement account and also take advantage of that home office setup and the deductions, and of course, accountable plans as well, to be able to offset some of that income and lower the taxes owed. Okay. So, of course, those professional consultations. So, consult with a tax professional to identify any last minute deductions that you might be missing, you think you might be missing. If you heard me talk about something or you heard someone else and you wanted to bring it to your professional and say, hey, I heard this crazy lady on YouTube say something, what do you guys think about this? And maybe that will be something that they can help you with to implement. If you do not have such professional, you can always come on over here and see Shane the Negotiator at Profit First Taxes. So here is my information for you to schedule an appointment. It's also in the description, bit.ly/SD Negotiator. You click the link to schedule a 15-minute chat for us to just kind of discuss your situation. If you're wanting to do more of a tax planning on something like that, it is going to be for a larger investment to do tax planning. All right. So again, the professional, they and we can provide personalized advice based on the latest tax laws and your specific situation. So everyone is different. We can have two LLCs that is different from each other. It can seem very similar. Well, you have an LLC is the exact same business that I have. I have an LLC is the exact same business that you have. But the tax planning can be different because you may want different things in your business. You may be at different financial points. You may have different financial goals. You may have different goals, period, on the direction that you want for your business. So those two LLCs may have completely different tax plans. Okay. So to wrap this up, it is important to stay proactive and informed about your tax deductions available to you as an entrepreneur. So even as the tax season comes to an end, there's steps that you can take to maximize your deductions and minimize your tax liabilities, okay? And to take advantage of those deductions and those credits, because we want a combination of both. You definitely want those deductions because, as I said, remember, deductions decrease your taxable income, and whatever taxes that you're owed that you owe the IRS, the credits could essentially wipe that down. Okay. So let's do some teasers for the next session that is coming up on the 1st of May, which is Monday, the day after my birthday. So happy birthday again to me. So on the next session, we're going to be speaking about evaluating your business financial health. So we'll be discussing how to assess your business financial performance post-tax season, that's after tax season, and of course, plan for a more profitable year ahead. So if you look through now that we're wrapping up, we're coming up to the end of tax season, and you're like, I didn't really like how my finances went in my business this year. We definitely will talk about some things that you can start doing to plan through for 2025 tax season when you file your 2024's taxes next year. Okay. So in closing, thank you so much for tuning in to today's tax savings tips for entrepreneurs. Those T's almost got me there. So if you found this information to be valuable, insightful, and beneficial to you, don't forget to come on over here to the YouTube channel, come subscribe, and share. And here's to a successful tax season and beyond. And until I come back on Monday, after I finish turning up for my birthday on this weekend, on Sunday, I will see you guys on the next one. Have a great and wonderful weekend. And for those who are celebrating and whatnot, happy Easter or Resurrection Day to you.